If you're watching this, there's a good chance you're not actually looking to retire in the traditional sense. You're just not sure if you want to keep doing what you're currently doing for another 10 plus years. And that's a very different problem because most successful executives eventually reach a point where the math starts to work, but the lifestyle stops making sense. You can still do the job and you're still performing at a high level, but somewhere along the way, the costs of doing it start outweighing the reward. And that's when a different question starts showing up. Not, can I retire, but do I have options? What if I stepped back? What if I worked differently? What if I kept earning income, but without the same level of intensity? And all of those questions will be answered in this video today. A transition that more executives are making right now, where work becomes optional long before retirement does. You see, most people think there are only two options: keep working or retire completely. And that's how most retirement planning is built. You work for 30 or 40 years and you save aggressively. And then one day you stop. The problem is life rarely works that way because most high performers don't wake up one day and suddenly want to do nothing. They just don't want the same level of responsibility, pressure, travel, meetings, and deadlines that they've been carrying for years. They want more freedom, flexibility, and control over their time. And that's where a lot of people get stuck because they don't hate work. They just don't want work to consume their life anymore. But there is a third option that's growing in popularity that sits between full-time work and full retirement. I call it hybrid retirement, and it's exactly what it sounds like. Instead of going from 100 to 0 overnight, you gradually redesign your work to fit the life you actually want. That could mean consulting, board work, fractional leadership, advising, project work, or even a small business you're excited to build. The possibilities are endless. You're still generating income, but you're doing it on your terms. And for many executives, that's a much easier transition than walking away completely. Now, this isn't just a lifestyle decision. It's also a financial decision. Because one of the biggest fears that people have about retiring is eventually running out of money. And the goal here is to stop needing to earn. Now let's make this real with a simple example. Let's say your lifestyle costs $250,000 a year. Most people assume that you need to pull $250K from your portfolio each year. But what if board work generates another $40,000? A consulting engagement brings in another $50, and a few advising projects add up to another $35. If the full $250 needs to come from your portfolio, well, that's one challenge. But let's say your hybrid income covers $125K. Well, now your portfolio only needs to provide the other half. And that changes everything. Because the biggest risk in the early years of retirement isn't running out of money. It's putting too much pressure on your portfolio too soon, especially if markets don't cooperate. If you retire and the market drops 20 or 30% in the first couple of years, the last thing you want to be doing is selling your investments to fund your lifestyle. And that's where hybrid income creates breathing room. It gives your portfolio time to recover, time to compound, time to do what it was designed to do. Let me give you a real example. I worked with a client who was a chief revenue officer at a SaaS company. Great income, strong bonus structure, and a team that he had spent years building. From the outside, everything looked successful. But he said something to me that I hear all the time. I can keep doing this job, but I don't want to do it at this intensity for another 10 years. And that became the real planning question. And the first thing that we realized was that his portfolio wasn't the problem. The structure was. Like most successful executives, he had plenty of assets: a 401k, a brokerage account, RSUs, cash. The issue was that everything was sitting in one giant bucket. And that's dangerous when you're transitioning away from a steady paycheck. Because money you'll need in the next year shouldn't be invested the same as money you won't touch for 15 years. So we organize everything into 3 layers. The first layer is liquidity, cash and short-term fixed income to cover his spending for the next few years. The purpose was simple. If the market dropped right after he stepped back, he wouldn't be forced to sell long-term investments at the worst possible time. The second layer was income, consulting opportunities or advisory work, or even future board positions. Anything designed to create flexible income during the transition years. The third layer was long-term growth, money that wasn't needed anytime soon, money that could stay invested and continue compounding. And the moment we structured it that way, the entire conversation changed. Because now he wasn't asking, can I afford to leave? He was asking, how much flexibility do I actually want? And the cash flow report from his financial plan allowed him to visualize this and make the best decision for his situation. Now, whenever I have this conversation with executives, the same two concerns usually come up: healthcare and taxes. Let's talk about healthcare first, because this is usually the thing that people worry about most. If you're stepping away in your 50s, Medicare is still years away. So the question becomes, how are you covering that gap? Maybe it's COBRA for a period of time. Maybe it's an ACA plan. Maybe it's a combination depending on your situation. The point isn't which solution you choose. The point is it needs to be a part of your plan before you walk away, not after. The same thing applies to taxes. The moment your income changes, the tax game changes too. You may still have income, RSUs vesting, severance, deferred comp, or maybe all of them in the same year. And if those pieces aren't coordinated properly, you can create a surprisingly expensive tax bill. This is why we model these transitions over multiple tax years, because some of the biggest financial mistakes happen during the transition itself. So here are a few common mistakes that anyone can make. The first is leaving without a liquidity bridge. On paper, the portfolio looks fine, but there's no dedicated cash runway, and then the market drops. And suddenly, you're selling long-term investments to fund short-term spending, which has a negative implication on your returns as well as your taxes. And that's not an investment problem. It's a planning problem. The second mistake is treating taxes like an afterthought. A lot of executives spend years building wealth and then make transition decisions without factoring in tax consequences. RSUs, deferred compensation, consulting income, Roth conversions, all of these can overlap. And if they're not coordinated properly, you can end up giving away far more than necessary. The third mistake is waiting too long to think about healthcare. Not because healthcare is impossible to solve, but because it's expensive to solve at the last minute. And the final mistake is the one that may surprise you the most. And that is assuming that this is only a financial decision, because it isn't. A lot of business leaders spend years attached to a title, a team, a schedule, and a sense of purpose. And when those things disappear, the transition can feel much harder than expected. I know, I experienced that myself when I left the corporate world. So the financial plan matters, but so does having something meaningful that you're moving towards. So if there's one thing I'd leave you with, it's this. You don't have to choose between working at full intensity for another decade and walking away completely. There are options in between. And for a lot of successful executives, those options create more freedom, more flexibility, and more control over how the next chapter looks. My team and I have helped clients make that transition through various different career and financial structures that allow work to become optional years before traditional retirement. And I've seen that the ones who do this successfully don't make emotional decisions. They make planned decisions. They build the bridge before they need it. And when the time comes, they leave on their terms. So if you'd like help mapping out what that transition could look like for you, book a free Wealth Clarity chat using the link below. My team and I would be happy to help you.